Hello and welcome back to Global Value. In today's video, we'll be performing a fundamental stock analysis of EGLE Bulk Shipping Inc., ticker symbol EGLE. At the time of recording this video, EGLE is trading for just over $72 per share. Their stock has done quite well year to date. They're up nearly 61%. Over the past year, they're up about 55%. However, since they went public, you would have done quite well if you had shorted the company, but you would not have wanted to purchase this on the open market after its IPO. Still, in the last 5 years, it's up nearly 18% compounded annually, even with this big dip during 2020. So we can see that EGLE is just off of its 52-week high, which is nearly double its 52-week low. There's about 9% short interest on the business currently, and the business is about a $1 billion market cap. For some background about what the business does, EGLE Bulk Shipping Inc. operates in the shipping and logistics industry. It's engaged in the ocean transportation of dry bulk cargoes through the ownership, charter, and operations of dry bulk vessels. The company's fleet is comprised of Supramax and Ultramax bulk carriers. The firm provides the following services: commercial operations and technical supervision, vessel maintenance and repair, vessel acquisition and sales, finance, accounting, treasury, and information technology services, and legal, compliance, and insurance services. It transports a broad range of major and minor bulk cargoes, including coal, grain, ore, pet, coke, cement, and fertilizer. EGLE Bulk Shipping was incorporated in 2005 and is headquartered in Stamford, Connecticut. So with that background about what the business does, let's get right into our fundamental analysis. We'll be performing an 8-pillar analysis as popularized by Everything Money, taking a look at 8 different financial metrics to come to a holistic, comprehensive beginning understanding of the business. So let's dive right into our analysis. Starting right off with pillar number 1, we want their average PE over the last 5 years to be below 22.5. So currently we can see that EGLE's trading at just over a 5 times earnings multiple. Their earnings have been all over the place over the last 5 years, and they've averaged out at about 1. So even though this is a check to start, there's not a lot of validity here as their earnings have been all over the place, very helter-skelter here. So that is a check on pillar number 1. But again, you don't want to put too much weight on that. Pillar number 2, we want their average 5-year return on capital to be above 9%. So over the long run, a stock is going to return what its underlying business returns, and the underlying business returns are going to be this return on capital. So we can see that they've done quite well during the shipping boom of the past year or so, but actually 3 out of these 5 years they had negative returns on capital. They average about a 5.7% return on capital, which is below that 9% metric, so pillar number 2 is going to be our first X. We're 1-1 to start. Pillar number 3, we're looking for 5-year revenue growth. This one's going to be a check. They've grown revenues from $237 million in 2017 to $595 million in 2021. One thing to note is that almost all of this growth came between 2020 and 2021, which makes sense as the cost of shipping has skyrocketed over this time period. So that's a check on pillar number 3. Pillar number 4, we want to see 5-year net income growth. This one's also a check. They had negative net income in 2017, and they have a positive $185 million of earnings in 2021. So again, 3 out of the 5 years here, they had negative net income, but they had quite a boom this past year, and that's going to be a check. So far, we're 3 for 4. Pillar number 5, we're looking at shares outstanding. We don't want a business to be issuing new shares and diluting existing shareholders, so we want them to be keeping this flat, or even better, purchasing back shares when the business is reasonably valued. We can see that for the most part, shares were pretty steady, although there was some slight dilution until a big uptick in dilution over the last year. They've diluted shareholders by nearly a third, so this is going to be an X. Ultimately, what this means is that when you're buying a stock, what you're really purchasing is an underlying ownership percentage of that business. And so by issuing new shares and diluting shareholders, the business is ultimately robbing you of the ownership of that company, and you're owning progressively less and less of the business. So if you had purchased the stock in 2020, you're now only entitled to about 60% of those profits that the business would have generated that would have been coming your way if they had not diluted you. So this can be a silent killer for investors over the long term, and that's an X on pillar number 5. Pillar number 6, we're looking for 5-year free cash flow growth. Free cash flow is cash from operations minus capital expenditures. It's this column here in green. Free cash flow can be used to pay dividends, buy back shares, pay down debt, make acquisitions, and reinvest back in the business. It's the lifeblood of any business, and a business's ability to produce free cash flow is ultimately what it should be valued based on. So EGLE has had negative free cash flow in 4 of the last 5 years, although last year in 2021, they had positive $74 million of free cash flow. So pillar number 6 is going to be a check. So even though this is a check, in an average year, EGLE is burning about $65 million of cash. And one thing to make note of is that over this most recent boom, over the last 12 months, EGLE has actually produced $151 million of free cash flow. So that's double what it produced in all of 2021. What you really want to understand when you're evaluating this business is that the shipping industry is extremely cyclical just by the nature of it. It has these crazy boom and bust cycles. So there's a delay in adding new capacity and adding new supply to the shipping industry, which is part of the reason it has this boom and bust cycle. So some major components to consider when potentially investing in this business is to understand what that industry looks like and where they currently are in that kind of cycle. And then the other thing, more business specific, is understanding what EGLE's management is doing with all this extra cash flow that they haven't had in years past. Are they just adding in a ton of more orders for new ships, or are they using this prudently to do things like pay down debt, buy back shares, reinvest in their business in some other way? So those are 2 absolutely critical factors that you need to understand as an investor if you're thinking about investing into EGLE. Now let's continue with our analysis. Pillar number 7, we want their net debt, which is long and short-term liabilities minus cash and short-term equivalents, to be below their average 5-year free cash flow multiplied by 5. So again, they're burning free cash flow in a given year. They have negative free cash flow, so pillar number 7 is going to be an X. However, remember that their trailing 12 months of free cash flow is about $151 million. So they would only need 2 years of their past 12 months of free cash flows to pay off all of this debt. So we really want to understand, is this boom that they're currently at sustainable? Is it just going to taper off, or is it going to come down with a very hard landing? So again, that goes back to the point of you got to understand both the industry dynamics and the business dynamics, and you really need to know this company inside and out if you're thinking about investing in it. So that's an X on pillar number 7. Finally, the big pillar of them all, pillar number 8, we want their market cap to be below their average 5-year free cash flow multiplied by 5. So currently they have $1 billion market cap. Again, they're burning free cash flow, so they have negative free cash flow. So pillar number 8 is going to be an X. If we compare their market cap to their trailing 12 months of free cash flow, currently they're trading at a 7 times free cash flow yield. Again, to rag on the same point and to beat a dead horse, you absolutely have to understand, is this sustainable or not going forward? So lastly, I want to analyze their dividend. Currently, EGLE Bulk Shipping pays out a very high dividend yield of nearly 8%, which is well above most other stocks in the market. So to analyze their dividend, really what we're looking for is a healthy and sustainable dividend that's well supported by their cash flows. So here we're looking at per share numbers, and we can see, just like we found out in our cash flow analysis, that in 4 out of the last 5 years, EGLE has had negative free cash flow per share. However, in the most recent calendar year, they've had positive free cash flow per share. They've had nearly $6 of free cash flow per share, and they've paid out about $4 in dividends. So they're paying back about 66% of their cash flow out directly as dividends to their shareholders. In the most recent trailing 12 months, EGLE has produced about $12 of cash flow per share, and they've slightly reduced their payout ratio. They're only paying about $6 of dividends a share. So now they're holding on to more cash, and they're paying out 50% of their cash flows as dividends. Obviously, this is very good for investors who want them to be returning capital. But if you're a longer-term investor in the business, you're going to want to understand what that other 50% of their cash flow is being used for, and why the company isn't paying out similar to those 60% rates. It's good that they haven't paid dividends in the years that they haven't had cash flows, and now that they have this really huge boom in cash flow, it's nice that they're returning cash to their shareholders. So in summary, EGLE Bulk Shipping checks the box on 4 out of 8 pillars. With a business like this, you have to be careful. They went from losing a lot of money with a very low return on capital to making a huge amount of free cash flow with a really high return on capital in just the last year. And a lot of that has to do with the global shipping boom that we've seen. The prices of moving shipping containers has absolutely gone through the roof. And so there is the potential that they're generating a lot of free cash flow. It hasn't been sustainable for them in the past. There's that potential that it could be going forward in the future. But to really understand that, you have to be an expert, especially in the global shipping industry. And then you have to absolutely understand how this business is allocating capital now and into the future to consider investing in EGLE bulk shipping. So this type of analysis is just a starting point. To do your homework and to learn more about the company in more depth, I highly recommend checking out the business's filings and getting a more general, more nuanced understanding of the shipping industry in general. You got to understand a business inside and out, just like you actually own the business, to really consider investing into it. Anything other than that is just really speculation. Well, guys, that's it for today's stock analysis of EGLE Bulk Shipping Inc., ticker symbol EGLE. If you enjoyed the video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next. Thanks for learning about EGLE Bulk Shipping with me, and have a great day.